Okay. All right. Well, welcome to our webinar. We are so excited to be with you this afternoon to discuss the One Big Beautiful Act that was passed earlier this year. I want to introduce our speakers first and foremost. So for those that don't know me, my name is Adam Brooks. I'm the founder of Able Financial Group and have a wonderful team around me today. Brandon Perlow is a certified financial planner, many of you know. He's going to be speaking today. Larry Van Quatham, also a certified financial planner. Matthew Cherry, another CFP, will be speaking today primarily on the technology that we have available to help our clients through the OBBBA. And then one of our newest team members, Jacob Cavallari, who's a CFP that joined us back in June and has already made a tremendous impact on our team. And we're just so excited to have him with us. He'll be speaking today as well. We have a full agenda, which I will dive into here. But before I do, I want to just share a brief disclaimer on the next slide, Joseph, if you don't mind, which is to simply say that we're doing our best to interpret a very, very large act. We are not CPAs or attorneys. Please seek tax or legal advice specifically for how the act may impact you. This presentation is being recorded today, and by participating, you are expressly granting permission for us to use your digital likeness, voice across our digital platforms. And should you object to this permission, please disconnect now. Now, with that, let me dive into the wonderful agenda that we put together. What's so nice about the team approach that we have is that we were able to take this enormous bill, divvy it up into some of the key areas that we feel are most important and impactful for our clients and their families. So I'm going to cover a little bit of just the background and introduction into the OBBA. Brandon and I are going to discuss some of the permanent features of the new legislation, and I put quotations around that, which we'll dive into here in a moment. Larry is going to dive into some of the nuances as it pertains to college planning and some of the rules and regulations surrounding that. And Jacob is going to be talking about some of the temporary aspects of the legislation. Matt is going to dive into some of the technology and resources that we have available to help our clients. And then we wanted to bring it home by summarizing some key actions that we're going to encourage you to consider taking in 2025 and those that you can consider waiting to 2026 or later. We hope to be able to open this up for questions, and there is a chat feature associated with this software. So if you have questions, please feel free to use the chat feature. We will do our very best to address your questions and allow time for them. So with that, on the next slide, I want to just highlight some of the key elements of this enormous legislation. So it was signed into law on July 4th, 2025. And at its core, it's an extension of the 2017 Tax Cuts and Jobs Act, which was set to expire at the end of this year. It is a massive piece of legislation, totaling 887 pages long. We do expect there to be some corrections and some updated guidance and things along those lines that help us crystallize some of the nuances around this piece of legislation. There is something for everyone in this tax law. So undoubtedly, there will be components of this that benefit you, that may not benefit you. There'll be parts of this that you like, and there may be parts of this that you dislike. There is everything in the kitchen sink that seems to have been thrown into this enormous bill. What makes it particularly unique is that there are components of this that are temporary in nature. that we know are scheduled to phase out over a number of years, and there are those that were deemed to be permanent. And I use that quotation again simply because it's only a matter of time before another administration comes in or decides that something that was permanent now gets changed. But for now, we're going under the premise that it's permanent until some other piece of legislation changes it. What also makes it unique is that some of the components are retroactive to the beginning of the year. Some were made effective when the legislation was passed into law in the middle of 2025. Some components don't actually start until 2026. Some pieces end in 2028 or later. And so there's a lot of meat around this piece of legislation. So with that as a bit of a background, I want to turn it over to Brandon, who will start diving into some of the permanent components of the tax law.
All right. Thank you, Adam. Thank you, everybody, for joining this afternoon. So, as Adam mentioned, there is a lot to this legislation. We're going to cover a lot of items here. And the first one is, again, as Adam mentioned, at its core, this is an extension of the TCJA from 2017. So the tax brackets we're familiar with for the last several years have now been made permanent. They were set to expire at the end of this year. And you can see the 2025 numbers in the chart on the board here. They will be adjusted for inflation annually. One thing that is unique, and this goes into effect in 2026, the 10 and 12% tax brackets are going to be wider with a double inflation adjustment for just this one time. And so the expectation for married filing jointly in 2026 and beyond, you can have probably $100,000 of income and be taxed at the 12% marginal tax bracket. So that's a pretty big shift. The 22% bracket is where that extra expansion comes from. So that bracket's going to be narrower. All the other ones are not going to be impacted, but they will adjust for inflation over time. This impacts everybody. So even if you're in the 32, 35% tax bracket, by having an expanded 10 and 12% tax bracket, that means you're paying less tax on those dollars earned. So this is a benefit no matter where you fall on the income spectrum. On the next slide, we'll take a look. So expansion of the standard deduction, this is another one from the TCJA. So if we remember back in 2017 and prior, the standard deduction was a lot smaller. It was doubled at that time. And the 2025 numbers were supposed to be $30,000 married filing jointly, $15,000 single. And then the OBBBA actually adjusted the 2025 numbers. So the new numbers, instead of 30,000 married filing jointly, it's 31,500. So if you take the standard deduction, you get an extra $1,500 married filing jointly, $750 single, and in between for head of household. This is a permanent change, and it's going to adjust for inflation moving forward. On the next slide, you can see now a limitation on itemized deductions. This is starting in 2026, so coming up January 1st. And this is something that's going to impact those of you who are in the highest tax bracket. So the new limitation here is if you take itemized deductions and you are in the 37% tax bracket, those deductions are now capped at 35 cents per dollar of income. In other words, 35%. So this is essentially a 2% penalty for deductions you're making in that 37% tax bracket. And this is kind of the first of many items we're going to talk about. So what can you do about it? Well, for now, bring these deductions into 2025. So to the extent that you can, we want to front load those, take advantage of the full 37% this year. Starting in 2026, that's going to be reduced, go down to 35%. On the next slide, you can see the child tax credit has been increased. This is a pretty small one, but still going from $2,000 to $2,200 per child. The phase-out ranges are the same as what they have been thus far. Phase-out starts at $200,000 if you're single, $400,000 married filing jointly, and it reduces on a graduated schedule from there. At this point, I'm going to turn it back over to Adam, and he's going to walk through some of the other permanent changes as it relates to our small business owners. So Adam, take it away.
Thanks, Brandon. So Brandon just highlighted a number of permanent components of the OBBBA that relate to individual filers. For our business owner clients, there's a few pieces of this legislation that impact you. So the first is the extension, which was made permanent, of the QBI deduction, qualified business income deduction was introduced as part of the TCJA, and it allows eligible taxpayers to deduct up to 20% of their qualified business income, and that was set to expire at the end of this year. That was now made permanent, including the 20% threshold. This applies to business owners that own pass-through entities, so things like sole proprietors, partnerships, S corps, LLCs, and the like. There's now a wider phase-out range, which means that it's easier to obtain. And they also included a new $400 minimum deduction for taxpayers with at least $1,000 of qualified business income. So that's part one. On the next slide, you'll see a number of other deductions that relate to our business owner filers. The first is a deduction for research and development related expenses. This means that expenses related to domestic research and development can now fully deduct or spread those expenses out over as long as 5 years. So it doesn't have to be capitalized. It can be expensed in the year, or determined that it's better to spread that out over as long as 5 years. Additionally, they approved 100% bonus depreciation deduction. That was also something that was part of this legislation. This pertains to property that was acquired going all the way back to earlier this year, needs to be placed in service sometime before January 2030, and you can depreciate multiple assets. So that's a big deduction for those business owners that are making those kinds of qualifying purchases. Expanded interest expense deduction, that's unique. And then they also expanded the qualified small business stock, or section 1202. Number one, they raised the limit of what's now defined a small business from one that's 50 million to as large as 75 million. So that's a nice size small business, if you ask me. They raised the capital gains avoidance from $10 million to as high as 15 million, which is again a nice benefit. And they shortened the required holding period from 5 years to 3 years. So again, a very nice benefit for our business owner clients. Another area, again, this goes back to maybe our individual filers, but this pertains, there were some legislation components or components of the legislation pertaining to both charitable giving and estate planning, which I want to cover briefly here as well. So this, starting in 2026, one of the new items related to charitable giving, for those that are itemizing, there's a new 0.5% AGI floor before being able to take the deduction. So this, for many, this might be similar to the same kind of methodology that's used when it comes to deducting healthcare related expenses. There's a 7.5 floor before you get to deduct any healthcare related expenses. They imposed a similar type feature here, but it's at 0.5%. So what this means is that if you have an adjusted gross income of $100,000, the first $500 that you give will not be deductible. It's only on the contributions to charitable organizations above that $500 in this example that would apply. Right? If you take the standard deduction, there's a new feature available. So keep in mind, as Brandon mentioned earlier, they expanded the standard deduction amount. So they still wanted to incentivize people to make charitable giving. There's a new deduction for those that give of up to $2,000 for those filing jointly, $1,000 for those filing singly. This only applies if you're taking the standard deduction. The punchline with a lot of these new nuances here are that If you're in a higher tax bracket, it may make sense for you to begin considering accelerating those contributions into 2025. If you're in a lower tax bracket, and or take the standard deduction, you will benefit by actually making those contributions next year. You'll get a higher deduction for the same gift. We're big proponents of things called donor advised funds. There's also strategies called qualified charitable distributions that people 70 and older can make from their IRAs. We'll talk a little bit more about that further. On the next slide, there are some nuances pertaining to the estate tax exemption limits. So because the TCJA was set to expire, there was potential that the estate tax exemption limit was scheduled to drop down to $7 million if that legislation had been allowed to expire. They enacted this legislation, increased the limit to 15 million for single filers, 30 million for those filing jointly. That simply means that you can pass an estate to your loved ones. If you're filing jointly, an estate worth less than $30 million, there will be no estate tax. On the gifting, that all relates to this, the gift tax exemption limits are basically still the same, currently $19,000 in 2025, scheduled to go up for inflation as things move forward. So with that, I want to now turn it over to Larry. Larry Van Quatham is going to talk a little bit about the OBBA and how it impacts college planning. Larry?
Thanks, Adam. So a couple of changes that came through on 529 plans, and some of this was before, but they've expanded now what qualifies as a qualified education expense. Previously, it was K through 12 qualified education expenses up to $10,000. In 2026, that's going to increase to $20,000. So if your child is going to go to a private school and you want to use a 529 plan to help pay for that, that is allowed. They've also now included the fees for the National Standardized Achievement Tests, so the AP exams, SAT, ACT, etc. Those are qualified for reimbursement as well. And then another new one that I think is really going to open things up is post-secondary credentials. So these would be for certificates if your child doesn't go to school at a traditional college, but maybe goes to a trade school or earns some certificates for different skills. The 529 plan should be able to cover those as well. Next slide. And then a lot of changes are coming through for student loan programs. The main thing to remember is if you have kids that are going to be undergrads, the borrowing limits have remained the same, but it is now eliminating a lot of the different several or federal loan and repayment programs for new borrowers. So all of those there, graduate plus loans, saving on a valuable education plans, pay-as-you-earn plans, those are all kind of going away. And they're going to be basically simplified into two different plans. There's on July 1st, 2026, they're going to change to a standard repayment plan, which will give you 10, 15, 20, or 25-year repayment plan, depending on how much you've borrowed. And then there's also going to be the repayment assistance plan, or RAP, and that is based on your percentage of adjusted gross income. So the lower income you have, the less you have to pay. And if you're not making the payment that's enough to cover the interest, the government will cover the rest of the interest to make sure you're not falling behind. So those don't kick in, until 2026, but it's good to know that they're coming. The other interesting wrinkle is the lifetime borrowing cap starting in 2026. So this is for mostly grad students. So grad students are going to be limited to $20,500 per year, $100,000 lifetime. Professional students, so those are doctors and dentists, $50,000 per year, $200,000 lifetime. And parents are now going to be limited as well, $20,000 per year, $65,000 lifetime. All borrowers combined is $257,000. Now remember, this is just for government student loans. So there still are private lenders out there that will loan money. It will be probably at a higher rate than what you can get from the government loans. But it is still possible to finance an education. Obviously, as financial advisors, we would prefer that you save for the education instead of finance it. But sometimes that's not possible. And our job here is to try and find the most efficient way to do it for you. So we will keep all of these in mind. And if you have any questions on this as your child gets ready for college, please come and see us. We'd love to help you.
So with that, let me introduce Jacob Cavallari, who's now going to shift the conversation towards some of the temporary adjustments that were part of this OBBBA legislation, and some of them are pretty unique. So Jacob, take it away.
Thank you so much, Adam. As you said, I'm going to be detailing some of the temporary adjustments for the new bill, starting off with the SALT deduction cap increase. So the SALT deduction is going to be your state and local income taxes, as well as your property tax or sales tax. From tax years 2025 through 2029, the SALT deduction cap is increasing from 10 to 40,000 for single and married couples with incomes below 500,000. This will increase 1% annually until 2029, and then it'll revert back to the previous $10,000 limit in 2030. As a heads up, there's a pretty steep phase-out limit from incomes between $500,000 and $600,000. So if you're going to be bumping up on that, I'd recommend you get in contact with your advisor. Next slide, please. Next, we have the enhanced senior deduction. This senior deduction is meant to offset a portion of your taxable Social Security amount. So from tax years 2025 through 2028, you'll be able to claim an additional $6,000 credit for individuals if you're 65 or older. This will phase out starting at $75,000 a year income for single or $150,000 a year income if you're married. And this credit is available whether you itemize or take the standard deduction. Next slide, please. We have no tax on tips, overtime, and the auto loan interest deduction. So from tax years 2025 through 2028, if you're making under $150,000 annually, you can now deduct up to $25,000 per year of your tips, or if you're making under $300,000 if you're married. The tips must come from a qualifying business. You may also deduct up to $12,500 of your overtime pay if you're single, or up to $25,000 of overtime if you're married. I want to note this only applies to qualified overtime compensation as opposed to base comp. Now, if you bought a new car this year and it was assembled in the United States, you can deduct up to $10,000 of the loan interest that you paid on it in the past or for this year. There's a pretty steep phase out at $100,000 to $150,000 if you're single, or $200,000 to $250,000 if you're married. Leases do not qualify, and again, this car has to be brand new and assembled in the United States. Next slide, please. Lastly, I'm going to be going over the Trump accounts. So if you have a child between 2025 through 2028, the child will be entitled to a $1,000 contribution from the government. This is meant to be a deferred savings / investment account that they will have access to when they're 18. As a parent or relative, you'll be able to contribute up to $5,000 a year indexed for inflation up until the child turns 18. Their employers also can contribute up to $2,500 a year in non-taxable contributions, but that does go against the $5,000 a year limit. Distributions are not allowed until the child turns 18, at which point the full account balance can be withdrawn. The IRS hasn't yet come out with exact rules on this account. There's still a lot of unknowns, but we can assume that the investments are going to grow on a tax-deferred basis, and college expenses will be a qualified distribution, meaning there will not be any tax. So if you've had a child from 2025 through 2028, look to open these accounts in middle of 2026, starting in July, and credits will be retroactive back to January 1st, 2025. Thank you, and Brandon will be going over some of the temporary credits that'll be expiring this year.
Awesome. Thank you, Jacob, for covering those. So this is kind of the other side of the equation. There are a number of credits that will be expiring, and you can see them on the screen here. So first off, if you are in the market for a new or used electric vehicle, you've only got a few weeks. So these credits will be expiring at the end of September this month. So you've got about 3.5 weeks to make a decision on this. It's $7,500 qualifying new EVs, $4,000 for qualifying used EVs. If you have questions about these credits, contact me, contact your advisor. Happy to walk through the details with you. The next on here, you can see December 31st, so not a whole lot longer, but you've got a little bit more time for residential solar battery storage credits and the energy efficient home improvement credits. So if you need to, get a new HVAC system, and it's something where, you've been kind of considering it for a while, I would encourage you to take a look at making that purchase before the end of the year. Take advantage of the tax credits that are available. Similar for solar, most of the folks on the call here are here in Arizona or Southern California. And, these systems, 30% tax credit, that's going to help go a long ways towards paying for the system. And without that 30% credit, it makes the math a little bit tougher. So the last thing I would say on that is, if it's something that you're considering, it can take a couple of months for all the permitting, everything to get done. So you really have about a month, maybe a month and a half to make a final decision on that and then get it all done before the end of the year. The last item on here, you've got a little bit more time until the end of June of next year if you're considering installing a level 2 charger, a fast charger for an electric vehicle at your home, at your residence. That credit, again, you got a little bit more time. On the next slide, a few other changes. So HSAs, health savings accounts, these are a little more administrative, but telehealth has been a qualifying medical expense on kind of a year-by-year provision. That's made permanent now. So if you have to use a telehealth provider and want to use your HSA, you can go ahead and do that. That's a qualifying expense. If you are shopping on the ACA, the healthcare.gov exchange, and you're looking at bronze or catastrophic coverage plans, those will be eligible. They'll be HSA eligible starting next year, so January 2026. Direct primary care is now allowed up to the limits that you see. Dependent care, flexible spending accounts, I want to highlight this. I mean, if you've got young kids or grandkids, you know that the cost for dependent care is very expensive. It's quite a bit more than $5,000 a year or $7,500 per year. So this is another one where, hey, starting next year, instead of a $5,000 limit, the limit's now $7,500. That's a nice extra benefit to cover some of these costs. And then on the next slide, we're gonna see here. So this is one that there's not a lot of details in the OBBBA. A lot more is coming. These don't start until 2027 for qualified elementary, secondary education scholarships. It sounds kind of similar to what we have in Arizona in terms of some of the state tax credits we have available. It's going to be up to $1,700 per taxpayer. You will not be able to double dip with Arizona or any other state tax credits, but beyond that, we really don't know exactly what this is going to be. So this is another area we just have to, pay attention to the regulations, and we'll keep an eye on it. And certainly, as we have more information, we'll be the first to share that with you.
Awesome.
Coming up,
So
next, yeah.
I'm gonna jump back in and just before we turn it over to Matt, I think one of the, we've covered a lot of the highlights and details surrounding the OBBBA, some of which are permanent, some of which are temporary, as we discussed. Ultimately, we want to be able to see how does this impact us and what does this mean for us? And, some of the things that we highlighted, like the 0.5% AGI limit on charitable deductions. Well, think about what I said. If your gift is $100,000, the amount that you will not be able to deduct is $500. All right. How much is that really going to move the needle for taxpayers? Same thing on the temporary interest deduction expense on automobiles, up to $10,000 of interest expense. Think about what that means on a 6% loan. That's a $160,000 car loan. Nobody has, I hope nobody have car loans like that. So some of the nuances here are may or may not be impactful. So the nice thing is we have some tools and technology to be able to demonstrate how these new laws impact our clients. And I'm going to turn it over to Matt, who's going to highlight a couple of the solutions that we have. So Matt, floor is yours.
All right. Thank you, Adam. Whew. Wow, that was, there's been a lot of information, and I'm sure you guys are just as overwhelmed as we were the first time we saw all of this. But don't worry, we have amazing technology we use to stay on top of everything. If you've logged into your eMoney portal recently and noticed your plan results shifting, don't worry, not a glitch. What you're likely seeing is the impact of the new legislation. Now, by default, eMoney used to assume tax rates would sunset back to the pre-Tax Cuts and Jobs Act level. Fortunately, the platform was already built to model both possibilities, sunset or extension. So when the bill passed, eMoney was able to update quickly without disruption. There are still some technical details to come as the IRS provides more guidance, but the major adjustments are already in place. That's why we'll be reviewing each plan with you to see how these changes affect your strategies like Roth conversions, charitable giving, and tax bracket management. Now, for example, Roth conversion strategies now interact with the new phase out of the senior tax credit. That doesn't mean Roth conversions are off the table. We still like them. It just means that we need to weigh the trade-offs more carefully before moving forward. And one reason we rely on eMoney is that it lets us see your plan from multiple perspectives: cash flow, taxes, estate planning, retirement plan scenarios, all in one place. Now, in addition to eMoney, we've also added Holistaplan. This is an award-winning analysis tool built for us, your advisors. It reviews your tax return line by line, and it produces a client-friendly report that points out opportunities, red flags, and strategies we might otherwise miss. So this is, again, where I reiterate Adam's disclosure earlier. Just to clarify, we are not CPAs. Holistaplan doesn't replace your tax professional. Instead, it enhances our ability to collaborate with your CPA and make sure nothing slips through the cracks. So Holistaplan is already updated for the new tax bill, and the results are pretty eye-opening. And on the next slide, we have an example of a case. So this shows the two scenarios, before and after the OBBBA. The report is laid out similarly to your 1040, and so it's fairly easy to read. As you see, the slide shows the filing status, age, and dependents are all the same. On the next slide, we show that all income as well is the same. And so the first change that we're going to see is on the next slide. Now, if you remember, a state and local tax deduction was capped at $10,000. Not anymore. So we see here that itemized deductions increased from $42,000 up to $46,500 with the enhanced SALT deduction. And the next slide shows the enhanced senior deduction added another $9,700. So this resulted in a taxable income dropping from $117,000 down to $103,000. Finally, on the next slide, the effective tax rate decreased by almost 3%. And the punchline here is that with the exact same filing status, same income, same deductions, their total tax bill decreased by about $3,800, over half of the original amount. This side-by-side comparison shows how much the new legislation can affect planning decisions and why it's critical to model these changes in real time. So, to wrap up, eMoney gives us the big picture view of your financial plan under the new law, while Holistaplan zooms in on the details of your tax return, showing the real dollar for dollar impact. Together, they allow us to stay proactive and adjust strategies, whether it's refining tax conversions, updating estate planning, or simply making your tax bill, making sure it isn't higher than it needs to be. And as we meet with you this year, we'll be reviewing these updates and showing you how the new tax bill applies to you specifically. If it's been a while since we've met, now's the perfect time to get on the calendar. And if your tax situation is more complex, running it through Holistic Plan can help us find opportunities. So now, as we all know, the plan means nothing without taking action. With that being said, I'll hand it back to Brandon to point out some action items to take by the end of the year.
Awesome. Thank you, Matt. And just to take a moment and reiterate what Matt just said, we know a lot of people file with extensions. That deadline's coming up. So if you're filing your 2024 taxes now, or if you haven't already and you're open to it, please do share your tax return with your advisor. Again, we're not CPAs, but there's a lot that we can do with the technology we have to improve from a financial planning standpoint. So the slide on here, so what to do this year, you've got between now and the end of December. So we started off by saying 37% tax bracket. If you're a top earner in the highest bracket, you want to bring your itemized deductions into this year. That's going to prevent that 0.5% AGI floor on charitable. It's also going to prevent that 2% penalty we talked about on all itemized deductions in the 37% bracket. If you're in one of the higher tax brackets, you're going to want to accelerate the charitable contributions into this year. And Adam briefly mentioned donor advised funds. That's one strategy we can use in order to help accomplish that. So something we are happy to discuss and would recommend doing sooner rather than later. Business owners, Adam went through a lot of the benefits for business owners, but 100% bonus depreciation is back, and that is effective as of January of this year. We talked about, so Jacob talked about the SALT phase out range, 500 to 600,000 in income. We want to try and avoid that to the extent that you have control over your income and can. That is a steep phase out, and it's a big increase in that SALT cap from 10,000 to 40,000. So we want to take full advantage of that if we can. We still like Roth conversions to Matt's point. Still very much, open and wanting to do them where it makes sense, but we do have a lot of additional considerations. So previously it really was, IRMA, which is the Medicare surcharge. That's still a consideration, but now we've got the SALT phase outs, the senior bonus deduction, which is brand new starting this year, the tips and overtime deductions, and some of the other things we've talked about here. So what's really nice about eMoney and the software we have is we can model all of this in one place and see what kind of impact it has. Jacob mentioned auto loans. So, this is really only available for the next few years. So if you're getting kind of a standard auto loan, you want to stick to a 3-year loan for a qualifying vehicle in order to maximize that deduction. Not sure, maybe it gets extended 2029 and beyond, but at the moment it ends in 2028. And then all of these expiring tax credits. So I mentioned briefly, so if you're in the market for a new electric vehicle, you've got just a few more weeks here. If you're interested in residential solar or need to do energy efficient upgrades, you've got until the end of the year. So this is just a small summary, but wanted to highlight the key actions items to take between now and the end of this year, while we still have a few weeks or in some cases a few months. And I'll turn it back to Adam to discuss what to do in 2026 and beyond.
Yes. So thank you, Brandon. A couple notes before I dive into this. So first and foremost, I know some of the slides may have been smaller print. So we will be happy to send out copies of the slides for those that request it. We will be able to provide a copy of this recording once it goes through compliance review and approval. And as always, feel free to contact any of your advisors with any questions as it relates to you specifically. In terms of what to do in 2026, One of the things that we talked about briefly before is if you are in a lower tax bracket because of the expanded standard deduction, you will be eligible for an additional charitable deduction, even though you're not itemizing. So consider, making that gift in 2026. Additionally, qualified charitable distributions become much more favorable in 2026. A qualified charitable distribution is for those that are 70 and a half and older, which is different than the required minimum distribution age. So 70 and a half and older, you can make a gift from your IRA directly to your charity of choice, and it does not even hit your return. It is the most favorable way to make a charitable gift. You cannot make that gift to a donor advised fund, however. So just be aware that it needs to go directly to a qualified charitable organization. In the topic of donor advised funds, these are often put together by a charitable foundation of some sort. And they all have various minimums and requirements associated with opening a specific donor advised fund. But what's nice about this is that you can you can bunch your giving in 1 year, make a large gift in 1 year and delay making a gift in another so that you can take advantage of itemizing potentially. You make that gift, put it into a donor advised fund. That foundation invests the money on your behalf. And when you're ready to make the gift, you go to that foundation and say, please distribute money from my fund to the charity of choice. You get the deduction in the year that you make the gift. You don't get the deduction in the year the gift is made from the donor advised fund to the charity, but it is a nice way for you to leverage the strategy of bunching your gifts into 1 year. That would make sense for high income earners in 2026 and later. With the new Trump accounts, we expect these to be open in July of 2026. The fact is, there's a lot of uncertainty around the nuances of these. It has not yet really been clearly defined. So we're going to be paying close attention to this. I know our clients, other professionals will also be paying close attention and more details to come, but this will be something that even if you wanted to open in 2025, frankly, you couldn't. Avoid the phase outs. So one of the things we really want clients to be aware of, for those that particularly are in the higher income levels, be aware of how some of these phase outs are impacted, particularly when you're talking about doing Roth conversions or things along those lines, where the Roth conversion in of itself may sound really, really great in terms of disinheriting Uncle Sam on qualified dollars, but it could move you into a higher tax consequence pertaining to Medicare premiums, or avoiding or eliminating some of your deductions pertaining to state and local taxes. You may lose some of the senior credit or senior bonus deduction, they're calling it, and some of the other deductions that Jacob talked about. Lastly, as Brandon mentioned earlier, one of the temporary credits is scheduled to phase out by the end of June of 2026. That pertains to the electric charging stations that those that want to put that in their house. That credit is going away in 2026. So take advantage of that prior to then. So we covered a ton of information. There's a lot of meat around this big, beautiful bill. We're here to be a resource for you. We encourage you to reach out to us. I do want to highlight the technology that we have is, and I say this with all humility, is truly best in class. The software that you saw as it relates to Holistiplan, where we can really dive into how this tax legislation impacts you by simply scrubbing your current tax return, is a really useful tool to make more informed decisions. And then, of course, applying that using the e-money software that we have to be able to look at your picture holistically is really it's a competitive advantage. It's really something unique. We're here. We're happy to help. We do have some time for questions. There's a chat feature that's available for those that would like to chime in. And with that, I will pause and let questions to accumulate. So on the next slide, there's some contact information available for the people that spoke today. We're here, as I mentioned, it's a privilege to be a resource for all of you and your families. Please feel free to reach out if we can continue to be of value to you. And we do appreciate your time this afternoon.